Welcome to the show, guys. I'm super pumped to bring on an expert. And actually, I love also buying real estate, buying investments and investing with other people's money. It makes life so much easier. You don't have to wait until you save up for 10 years to be able to buy your first property. No, we can actually utilize other people's money. And on top of that, we're also blessing them with a good return on their money. So I have a fantastic expert on with me, Dave Dubeau. Thank you so much for being on the show to walk us through how we can actually partner and make even more money and help other people at the same time.
My pleasure. Thanks for having me on the show, Dustin. Thanks for being on mine recently as well.
Absolutely. Yeah, it's terrific. I love podcasting because we get to meet so many great people. Now, Dave, tell me about what do you do in investing and in helping people either to raise capital or anything like that? Because when you're looking at raising money, you have to be able to know what you're doing. You have to have experience and all that sort of stuff. But talk to us about yourself.
Yeah, for sure. So I got into real estate investing about 2003. Kind of like following your path, my friend. So one of those gurus, you too can get rich with little or no money down, set away for the course, took massive action, did 18 deals in 18 months to get started, single family home type stuff, transitioned later on into got into buying whole type properties with single family homes, doing a lease option rent own type strategy. And since then I've scaled up into investing in multifamily properties. And a while ago, Dustin, I realized I kind of suck at tenant and toilet management myself. So these days, I'm more of a passive investor and I let the experts do their thing. And these days, we help mom and pop real estate investors raise capital, find their own private capital to grow their portfolios.
Now, would it be portfolio in all types of investing from multifamily to residential? Is that the thought, just basically all type of investing?
Yeah, pretty much all types of real estate investing. So we've got folks doing exactly what you do. So buying single family home, kind of like turnkey type properties. We got people doing BRRRRs, flips, lease options. We got people in the multifamily space, self-storage space, mobile home space, car wash space, kind of you name it. Land space, tax liens, tax deeds, notes, so the whole gamut.
Do we need to have experience in real estate investing in order to do like partnering with people to raise capital to buy real estate?
It sure as heck helps. I mean, we got to be, I could pump people's tires and say, hey, you don't need to have any experience or any clue when somebody's going to invest with you. Probably not. Because here's the reality,
I wouldn't invest in somebody who has no clue what they're doing.
And why would anybody, right? Because quite frankly, you need to know what the heck you're doing. And ideally, you need to have a bit of a track record. Now, here's the good news. You don't have to have a ton of experience. If you've got even one successful deal under your belt, you're ahead of 95% of the population who has never purchased a single revenue property. Their own house does not count as a revenue property. So you don't need a ton of deals. You don't need a ton of experience, but ideally at least one deal under your belt.
That makes a ton of sense. Okay. So what would you suggest is like the first start to, is it finding the deal? Is it finding the investors? How do we get started in utilizing partnering and utilizing other people's money in order to start investing?
Well, when I had you on my show, Dustin, you were bashing the gurus. I bash the gurus too, because I always hear this thing, hey, just find a good deal and the money will find you. I don't know who came up with that expression. I would like to smack that person right upside the head, whoever came up with that in the first place, because it's a recipe for disaster. That's easy for the gurus to say because they've got platforms, they've got podcasts, they've got thousands of followers. They can put a deal out there and raise capital easily. But if you're just getting started, if you don't have that kind of a platform, here's what you need to do. You need to get your investor ducks in a row first, and then go looking for the money, go looking for the deals. So chicken and the egg, which comes first? Get your investors first, then go looking for the deals. And then once you've got that, keep both things going at the same time.
So how do you make a private money lender or somebody that, you're trying to part with somebody, how do you make them comfortable enough to lend you money? Because if I've found that if you present the deal, that's so much easier because you already have the deal. You're already saying, here's the numbers and all that sort of stuff. And you can explain that. But how do you make sure that the investor is comfortable with you?
Oh, for sure. Well, it's actually very, very simple, Dustin, especially if you got that 1 or 2 or 3 deals under your belt already, because you don't need to show a specific deal that you're working on right now. What you want to be able to show is an example of the kind of deals that you do. So in your case, you've been doing this for a long time. You got tons of experience. pull out one of your deals and use that as a case study and say, hey, here's what we do all day long, every day, day in, day out. These are the kind of properties we buy, and this is what we're looking to do with them. And this is how it typically works out. Are you interested? Would you like to be involved in our next deal? Great. Let's get you signed off on an expression of interest. And then next time I've got a deal, you get the first dip.
I like that idea. Now, with that, a question I always get from all my students and everything, they're asking, well, how much money or what percent return, like how do I structure the deal? What terms should I do? Is there a formula, or how are your thoughts about making the terms and everything else fit for the investor?
That is an awesome question, Dustin. Now, can I assume here that we're talking about people doing similar type deals to what you like to do? So single family homes, kind of that cookie cutter idea. Well, here's what I would recommend. That is, number one, the safest way for you to do it as the active partner. Number two, the easiest way to explain to your investor partners. And number three, the biggest win-win for both of you. So here's what I would highly recommend in that situation is that you bring on your investor partner as a joint venture partner on the deal. So you are actually co-owners on that property. You're not offering them any specific return on investment, but what you're offering them is 50% of the deal. You're saying, hey, say your investor's name is Joe. Hey, Joe, here's what we're going to do. We're going to partner up. You're going to bring in the money, and you might even help us get qualified for financing for the property. I'm going to bring the deal to the table, the team, the experience, the know-how, the management, all of that. We're going to join forces. And here's the deal. Here's how I think it's going to work out. And we're going to share the profits 50-50. And bottom line is, Joe, if I don't make you money, I don't make any money myself. So it's in my best interest to make sure that this property is as profitable as humanly possible. So that, Dustin, in my estimation, is the absolute simplest, best, and safest way to do it. Because here's the thing, right? If we're offering a specific return on investment, that's fine as long as everything's going according to plan. But what if you got a vacancy for a month or two? What if you got some stuff that you got to repair on the property? What if, right? So you want to make sure that you're covered there, and that you're also, able to offer your investors an attractive return on their money, right? So that's what it's all about. So here's another big tip. When you are showing people your pro forma, you are doing a presentation with them, you're showing them what the deals look like, I'm going to suggest that you want to take Tom Peters' advice, which is to underpromise and overdeliver, right? So I know, Dustin, that you've probably got some properties in your portfolio that were absolute home runs. Would you agree?
I do.
Yeah, those babies that were just like, oh my goodness, if I could do those every single day, I'd love it. And here's the temptation. The temptation is to show those suckers off because we're so proud of them. We're so proud of what a huge discount we got on it, what a bargain we got, how incredible the cash flow is, or how much we boosted up the value of that property. But here's the challenge. If we show those deals off as our example, one of two things is going to happen. Either the numbers are going to be too unrealistic for an average person to get their head around, and they're going to call BS on you. Or number two, we're going to kick in the greed gland, and that's going to set up those expectations. That's what they're going to be looking for. So instead of doing that, let's go in there. Let's be conservative. We obviously want to offer them a decent return on their money, but we want to do our best to actually exceed those expectations.
That makes sense. Now, I love residential, but I also love investing in multifamily storage units, and I literally invest in hotels too, which is great. Now, one thing that's kind of I've been thinking over is the idea of syndication. That's, syndications where you raise money to buy an apartment complex or multifamily, and then within 3 to 5 years, you exit it and hope that somebody else is going to buy it for more. So you exit with money. So I'm not a big fan of that personally. Now, I do invest in them, but I like buying whole. I want to hold onto it. Let's say that I wanted to I wanted to have a multifamily. I bought a 100-unit apartment complex, and I wanted to get other partners to come and invest with me. How do I, instead of the syndication model, which is almost like, you have to get the next sucker to buy it for higher, not saying that they're suckers, it just kind of seems like they have to buy it for higher just so you get your money back on top of the passive income. If I wanted to buy that investment property, that 100-unit apartment complex, get investors to help me, I give them a good return. And then how do I eventually get them out so it's all mine?
Yeah, that's a really good question. I don't have personal experience doing that, Dustin. However, I have seen other people who've done something similar to that. And basically, what you want to do is you want to be able to offer them an assured return on their money. And you want to get it to the point where, let's say 10 years down the road, you can refinance that property and buy them out for, X amount above what they invested in the deal. So they're getting cash flow throughout the deal. And then you say, okay, at the end of 10 years, I have the option to buy you out for 150% of what you paid into the deal, or whatever your agreement is, 200% more than what you paid into the deal. So that way your investors are getting a really good return on their money. Plus they've gotten the cash flow, the depreciation, all those great things throughout the time. But you got to set all of this up ahead of time. You have to have that in your offering memorandum, or in this case, you'd probably have a certain corporate structure set up so that you could buy back their shares at that time. Does that make sense?
Yeah, it absolutely does. I love that idea because I invest for generational wealth and I want to be able to.
You want to pass this on to your kids, right?
Absolutely.
You got lots of them. So you want.
So Dave, you also have, you have a great calculator on your site where walk through as an investor, somebody that's going to be putting together deals.
Yeah.
If you were able to, instead of using your own money, you're like saving up for 5-10 years and then buying one property, saving up more. And if you were able to partner with other people, which is a very, very smart thing to do. Now you have this calculator. Now it shows like if you were to walk through this process of partnering with other people, you can grow so much faster and get them also a great return. Tell me about that.
Well, it sounds, I'm not a math guy. I don't think you are either, Dustin. So calculator just sounds terrible. I don't have a better term for it, but I call this my private capital profits calculator. So this is fun with math. And if you want, Justin, I'll share my screen and I'll walk you through it. And can we walk through an example of the kind of deal probably one of your students would be doing? Can we do something kind of typical that way? Totally. So we're probably looking at a single family home type deal, right?
Yeah, it'd be residential, so it could be for 4 units and below. But yeah, so let's say
it's one of your 3-2s that everybody likes to buy and rent and all over the place. So you guys, what we're doing here, I'll walk this through. I'll try and talk it through as well. We're going to take a look at what one investor is worth to you and your net worth over time, right? So what even just one investor, what kind of a difference that can make to your net worth? And I think it's going to be a mind-blowing number unless I screw things up here. All right. So let's see, Dustin, what's the average price of a property that we'd be looking at here? This 3-bedroom, 2-bath. What are we looking at?
Average is probably about, let's say $125,000.
$125,000. And I'm just going to put a parameter here of a 10-year time frame. I know you're a generational kind of guy, but let's have a start and an end date so we can kind of wrap our heads around this better. All right. So 10-year time frame. Are you and your students typically getting a bit of a discount up front on these kind of properties?
Always. Yeah. We're an investor. We capture equity. So I'd say at least 15%, we try to capture equity on the property.
Okay. So on $125,000, you probably be getting about an $18,000, $19,000 discount, give or take.
Sounds right.
Okay. Down payment and closing costs and transfer taxes.
I'd say about 20% for down payment.
You know what? Let's be conservative. Let's say it's 25% just to make it a little higher there.
Oh yeah. You have closing costs in there too. Yeah.
Exactly. So let's say it's 25%. So that'd be about $31,000. So that means our starting mortgage on this property would be about $93,000, $94,000. And what do we say the interest rates are about now? 6%?
Right, at least 6%. Yeah.
Okay. 6%. Amortization, 25.
I like 30 years personally. Yeah.
Let's try and get it for 30. All right. So our mortgage pay down over 10 years at 6% and a $93,000 mortgage is going to be about $15,000. Does that sound about right?
Yep.
If my calculations are right, that should be right. Now, we've got a discount on the property. Are you doing stuff here to force up the value of the property?
We always do. So we try to buy the worst house on the block. So I would say at least 10 or 15% increase in the forced appreciation.
All right. So let's keep it simple. We'll say it's a 15% increase. So that's going to, we got an $19,000 discount. Plus we're going to increase the value about $19,000 above what it was originally as well. So there we go. So we got forced appreciation. And what's the cash flow on average per month?
We minimum always $250 a month.
And that's after you paid property management and everything.
Everything.
Correct? Yep.
Yep.
So
On top.
$250 cash flow. So that'd be about $3,000 a year, $30,000 over 10 years. Is that right?
Yeah.
Okay. So according to the calculator, our total deal profits in this 10-year time frame on this deal are $132,000 between instant equity, our mortgage pay down, forced depreciation, cash flow, and market appreciation. Total profits about $132,000 on this $125,000 property. That ain't bad. Does that sound about right, or am I
Sure does.
out to lunch? All right. Now, are we going to keep it simple here and do a 50? Let's assume that we've brought an investor on board, like a joint venture partner. They're going to put up all the money, maybe even help get qualified for the financing, and we're going to split things 50-50. Would that be fair?
Yeah, definitely.
All right. So then our share of the $132,000 is going to be $66,000 over that 10-year time frame. Sound right?
Yeah.
All right. Very good. So now let's take a look at what an investor is worth to us with this kind of a deal. All right. So this kind of a single family home, I'm going to recommend we just want to have one investor on board coming up with the money. So in this case, they only have to be coming up with about $32,000. So we don't want to spread that amongst too many people. So one investor for this kind of deal. Does that sound good?
Sure does.
Okay. And Dustin, you've been doing this for a while. What is your best guess over a 10-year time frame? How many times will an investor reinvest with you or do a deal with you?
I would probably say probably about 10 times over the, like, let's say over 10 years.
Over
I would
10
hope
years?
maybe one over 10 years. Yeah.
Okay. So should we be super conservative and let's say it's 5 or 6? Like,
sure.
Not everybody's going to do a deal every year. So let's just say 5. All right. Okay. Well, this is getting exciting now. So we got one investor needed for this kind of a deal, and they're going to do 5 deals with us over time. So that brings up the value of that investor to $330,000.
And when you say value of an investor, that's somebody else that's investing with you.
Exactly. They're helping us to create $330,000 worth of wealth between all of the different profit centers that we're talking about there. So does that make sense? Now, here's the other side of the coin.
Great.
Wouldn't that be the same? If we're doing a 50-50 split, isn't that the same amount we're creating for them?
Yes.
That's huge. That's life-changing money. Now let's take it one further. So we've got this investor. They're doing deals with us over the next 10 years. Do you think they might refer somebody else to us who also becomes an investor?
If you're making them $330,000, then I would hope so. But yes, I would definitely, at least one.
At least one. All right, let's put in there one. So if they bring on one investor, that effectively doubles how much they are worth to us. So now the lifetime worth of an investor is $660,000 to you and your family. Is that pretty cool, or is that pretty cool?
That's amazing.
That is. And that's just one investor.
That's the reason why we love using other people's money. I love that term, O.P.M. Other people's money, because what happens is you have a compounding effect on everything, and you don't have to be waiting forever, I don't say forever, but like many years to save up all that money. You're able to also help other people be investing with you. I kid you not, I have a Rolodex. I just have so many people that want to invest with me because I have a proven track record of being able to make myself money and my family money. Everybody wants to be a part of it. If I say, hey, I have this deal, like there's hands raised up all over the place. Exactly.
And that's what we want to help our clients do, is get to the point where they've got a bunch of investors waiting in the wings saying, hey, Dustin, when's your next deal? I want in, man. Take my money. I want to invest with you. Because here's the thing. Most people, because here's the challenge we have. And I'm sure I say this with love and affection, but you and I and all of your followers are what I affectionately call real estate weirdos, right? We love this stuff. Why else would anybody be listening or watching a podcast about real estate investing? But here's the thing. Most of our friends, most of our family, most of our network are not like us. They are not into real estate investing. So when we can bring them on board as a passive partner, as a passive joint venture partner, where we do all the work and they bring in the money and perhaps help qualify for the financing, then we're helping them do something they cannot or will not do on their own, and that's invest in real estate.
I love it. Dave, this is really, really brilliant. And I hope people realize that just the compounding effect of helping other people, number one, but then fast tracking everything that you're going to do in real estate. So Dave, how can everybody find you online and connect with you?
Well, perfect. Thanks, Dustin. So I got a brand new podcast I've just released. It's called the How to Raise Capital 101 Show for Real Estate Investors. So wherever you're listening to this fine podcast, you can find mine, the How to Raise Capital 101 Show. And the first 9 episodes are like a little mini course on my whole, what I call money partner formula. So you don't need to opt in. You don't need to sign up for anything. Just go check out the podcast and listen to those first 9 episodes, and that'll give you a great overview.
Fantastic. Dave, thank you so much for all the wisdom. Hopefully people are going to take advantage of it. So I really appreciate you, man.
Thank you, Dustin. Take care, my friend.